My name is Jake, welcome to the channel. In today's video, we're gonna talk about, wait a second, what's going on here? I'm a cat. I gotta have a filter on. There's something going on here. I think I have a filter on. Let me see if I can fix this, everybody, before we dive into the video. Oh man, I am so sorry, how embarrassing. One second, let me see if I can find the filter. I don't know what's going on. It wasn't here before. What is going on? Oh, this is embarrassing, everybody. I am so sorry. I'm ready to go forward with the video if it's okay with you. I promise. What is going on? I'm not a cat. Oh, much better. There we go. There's the portfolio. Sorry about that, everybody. I don't know what happened there. It must have been a filter or something. Anyways, in today's video, we're going to talk about the dividend matrix. So what do I mean by dividend matrix? It's really just a way of visualizing how different companies, different stocks are to be positioned into your portfolio based off of their growth rates, the time horizon. This video is going to build upon a little bit of what we talked about in our last video around time horizons, around the math when it comes to investing in a dividend growth strategy. So this video is geared towards new investors that are trying to build out their portfolio, but maybe a little bit unsure of how they should structure their portfolio. The most important thing is when you're investing in this type of strategy, a dividend growth strategy, and you're trying to live off of the dividend cash flow from your portfolio like my wife and I are trying to do, it is so important that you understand the different dynamics of how each company should be represented in your portfolio. It's not very complicated, but I think it's very important to understand that every company is not created equal. Just because a company has a great brand, it's a great company, doesn't mean that it should be in your portfolio or make up a substantial position in your portfolio. So that's what we're going to talk about in this video, as well as I want to kind of break it down visually, as well as think about, okay, if you were to invest a certain amount of money into an individual company, how much in cash flow, how many dividends are you going to get in dollars every single year based off of that investment? So really interesting stuff. I think a lot of you, especially if you're a new investor and you're interested in building out a dividend growth portfolio, or you're looking to revamp your dividend portfolio, I think you're going to get a lot of value out of this video and a lot of inspiration when putting together your dividend growth portfolio. If you've been following my channel, I kind of sound like a broken record. I always harp on that time horizon really dictates how you should be investing, how you should be constructing your portfolio. Not every company is created equal. I absolutely love Visa, I love Apple, but they don't really hold a large position in my portfolio for a fundamental reason, because I want to live off of the dividend cash flow from my portfolio. So it's very important to understand my investing strategy is to never sell off my core holdings so that I can have them in my portfolio so that they can build generational wealth and so that the miracle of compounding can really take over. So the type of strategy that I'm sharing on my channel, it's not put everything into Visa or Disney and then in 20 years sell everything and then rebalance your portfolio into higher yielding companies. That's not really my approach. However, I will say that approach can work very, very well, but it's not the approach that I personally am taking. Okay, so I think it's important if you're maybe new to my channel, it's important to understand that. And I talk a lot about financial independence and retiring early off of my dividend growth portfolio. And my goal is to slowly and steadily grow up my dividend cash flow from my investments, brick by brick, step by step, and not really just focusing purely on growth and then hoping that they go to the moon like GameStop and then sell at the right time and then, retire tomorrow. That's not really my approach. So what are we looking at here? So I put this together here this week. I had a lot of fun with it. It's kind of interesting to see how different companies are, growing at different rates and what type of investments you should be holding in your portfolio. And once again, the last video that I put out here on the channel was around the simple math of dividend investing or retiring off of your dividend portfolio. If you haven't watched that video, I'd highly recommend you take a look at that video as well, because a lot of this will make sense. They kind of build off of each other. So what we're seeing here, the matrix on the y-axis, we're looking at the dividend growth rate. So this is just the dividend. On the x-axis, we're looking at your time horizon in terms of years. So it really doesn't matter if you're in your 20s, your 30s, your 40s, your 50s. What matters is your time horizon. Time horizon meaning, so if you want to live off of your dividend growth portfolio, it could be you're going to be building up your portfolio for the next 10 years. And that doesn't matter if you're in your 20s or in your 40s. The type of investments that you invest in, it really comes down to when you plan on living off of the dividend growth portfolio. So really important there. So I think there's a myth out there when it comes to like, hey, if you're in your 20s, you should only invest in a Microsoft and Apple. Well, actually, no, because it depends on when you want to live off of the dividends. If you're 20 years old and you want to live off of your dividend portfolio in 10 years, I don't think investing into Apple, Microsoft, and Visa is going to help you reach that goal if you're like me and you never want to sell your shares and just live off of the portfolio. Okay, so there's a few important things to understand, but I think that's really the gist of it. And I do want to say that, you know, if you wanted to go the growth route, put all of it into your growth stocks and then hope that in 10 years that the value has gone up and then reposition, sell it. I don't talk bad about that. I think that approach could work absolutely fine, but it's important to understand when you're watching and viewing my channel, that's not the approach that I'm talking about. All right, so how do we look at this? So the bottom left, this is gonna be your high dividend yielding companies, right? And the higher they up here on the y-axis, that's the higher the dividend growth rate. So if you're looking to retire in the next 10 years, you wanna look in the bottom left here with Altria Group, Coca-Cola, Southern Company, and Verizon. So if you're looking to retire earlier, what you want to focus on is you want those high yielders to make up the bulk of your portfolio. It doesn't mean that you put all of your money into Coca-Cola and Verizon and you disregard everything else, but you would want to overweight your portfolio. So when I was first learning about investing, when somebody would say overweight and underweight, I was so new to investing, I was just kind of nodding my head. Yeah, overweight, underweight. My channel is geared towards new investors. So what I mean by overweight is the bulk of your, the target allocation of your portfolio. Let me see if I can go ahead and show you this in M1 Finance. What I mean by overweight, it really comes down to your target. So you're going to put the majority of your portfolio in a certain asset or asset group, whatever you want to call it. Overweighting it means that the bulk of your portfolio is in one specific investment. If it's underweight would be the lower positions in your portfolio, okay? So for some of you watching the video, this is going to be old information. It's not new information. You might be thinking, oh, I'm well beyond that. But there's a lot of new investors that are following my channel that I think, they sometimes it can be embarrassing to ask such simple questions, but it's so important that you understand these simple concepts, overweight, underweight, and I talk a lot about that on my channel. And once again, my channel, it's not towards, your professionals out there that are, that have been trading for 10, 20 years or investing for 20 years. My channel is really focused on new investors. All right, so now that we understand, okay, if we're looking to retire maybe in 5, 10 years, we want to focus or centralize our portfolio on the bottom left here. Let's say, for example, we want to add a little bit of a mixture or different companies into the portfolio that are still yielding a good percentage, maybe 2, 3%, but they're also growing at 7, 8, 10, 12%, for example. That's going to be in your box up in the top left. So when you're thinking of building out your portfolio and you're thinking, okay, I got my Coca-Cola, I got my utilities, I got my telecoms, right? Your Verizon, your AT&T. Now I want to build on that and add another layer of high dividend yielding companies. A few examples that I really like Pepsi. Pepsi is a great one, 3M, Union Pacific, and Air Products and Chemicals. If you watch my last video, I go into detail about the growth rate of Air Products and Chemicals. Really, really interesting video. Really recommend you check out that last video if you haven't already. So this is what we're looking at. So on the top left, your high dividend yielders. Now, for me personally, I don't think it's wise to say, okay, I'm going to put everything into Union Pacific. I'm going to put everything into 3M. But balancing out your portfolio with these type of investments will help you reach that goal of living off of the cash flow. And I'll show you in just a second how the cash flow is going to differ based off of the investments if you were to invest a certain amount of money. So stick around. It's actually really interesting. Now, if we go to the bottom right here with the low dividends, but with a longer time horizon, this is where we're looking at maybe your Procter & Gamble, your Johnson & Johnson's, your Kimberly-Clark's, and your McDonald's. Now, here's the thing. With Kimberly-Clark and Johnson & Johnson and Procter & Gamble, these could actually, depending on, a few things, these could actually go up into this section of the matrix as well. You could say, I'm going to take Procter & Gamble and I'm going to put it up here because for me, that's, I'm looking to retire earlier. It fits into this bucket, right? So you could do that. I mean, that would work absolutely fine. You could say, all right, well, Kimberly-Clark for me, by my definition, is actually a high yielder, and I'm going to put this more towards in the middle. You could absolutely do this. The reason why I have these bucketed the way that I do is so that you can think about it when you're building out your portfolio and you're constructing your weighting, the target weighting, once again, going back here to M1 Finance, right? When you're constructing, okay, what percentage of my portfolio, how do I want to have the allocation? For example, you got Coca-Cola in my portfolio, Kimberly-Clark, Pepsi, and Procter & Gamble. At the higher end, like these are my core positions, they're not all yielding the same. I view them in these kind of buckets right here. So I think, okay, I want to round out my portfolio with maybe some other companies like a McDonald's that I'm not going to live off of the dividends ideally, tomorrow, but this is more of a growth play that's supplemental to my core positions in my portfolio. Okay, really, really important to understand that. But here visually, I love having it here visually because I think, okay, when I'm building out my portfolio, which companies are going to be my core holdings and which companies I'm going to supplement or build off of. And then lastly, here up and to the right, the low dividends, high growth rate up and to the right, you got Waste Management, you got American Tower, Visa, and Apple. Now, if you dive into each one of these companies, they all yield very different rates and they're all growing at a different rate. With Visa, they're growing their dividend over, 10 plus year over year. Same with American Tower. Waste Management is not growing nearly as quickly. Same with Apple, but they are the lower yielders, but they're growing faster than, for example, a Pepsi or a Verizon in terms of the dividend growth rate. And because my time horizon is just around the corner, I say just around the corner, 7, 8 years, for me, that's why I place them up and to the right. They're going to supplement my portfolio, but only very marginally, okay? For example, if we go into my technology slice, and this will make sense in just a second when I show the next part here. So stick with me. So here with technology, I have Apple, Microsoft, and Visa in just a very, very small allocation. I still have them in the portfolio, but they make only a very small marginal piece of my overall portfolio. Okay, and I'm going to show why that is in just a second. The reason why I'm showing this to all of you is so that you can do this yourself, so that you can think when you're constructing and reviewing your portfolio. I would encourage you to think about it in buckets like this. Think about, okay, what are your core holdings? What are the ones that you're going to rely on, or the ones that are going to be your heavy hitters, the ones that are going to, get you the cash flow that you need to retire early? For me, that's a Southern Company, that's a Verizon, that's a Coca-Cola, that's an Altria Group, that's a 3M, a Pepsi, even a Kimberly-Clark and a Johnson & Johnson, Procter & Gamble. For me, those are part of my core holdings. And the others here with Waste Management, with Air Products and Chemicals, Union Pacific, American Tower, those are going to supplement my income, right? And then because my time horizon is forever, once I get into, 20 or 30 years down the road, the portfolio is then going to start compounding. And once again, this would make a lot more sense if you've watched my last video on the math behind dividend investing. All right, now let's take a look at this and view this from a different lens, right? So if we were to invest $10,000 into these individual companies, what would be the annual cash flow that you would get? And what I like to do is I like to look at the yearly dividend income that you would get based off of a 4-year historical average. Now you could say, okay, I'm just going to invest $10,000 into XY company. What would it yield today? The reason why I like taking the 4-year historical average, not a lot of people talk about this. The reason why I like doing that is because I dollar cost average into my portfolio. I'm not just buying, $10,000 of Altria Group today. I'm averaging in over years and years, and Altria Group is not going to average the 8% that it does today for the next 4 years. I like taking the historical 4-year average. Really, really important, especially if you're like me and you're dollar cost averaging. You don't, in the best case, you don't want to just look at what a company is yielding today, especially if you're using M1 Finance, which auto rebalances. Very, very important, because you're dollar cost averaging over the lifetime of your portfolio, or as long as you're reinvesting dividends and funding the portfolio. Now, if we were to just take an example, let me show you how you can get your 4-year average yield. Go over to Seeking Alpha, type in the ticker in the search bar here, and then go under dividends and then dividend yield. And this is how you can find the 4-year average yield. For the 4-year average yield, it's been right under 6% for Altria Group. Now with Altria Group, it's yielding just under 8% today, right? But because we're dollar cost averaging into the portfolio, that is why I'm taking the 4-year average yield and not the current yield when I'm factoring in these numbers and when I'm looking at the different investments. That's why I take the 4-year historical average. All right, so let's take a look at it. So if you were to invest $10,000, you were to average into your portfolio, you could expect right around $600 in annual cash flow if you were to invest $10,000 into Altria Group, right? And once again, specific for this video and for the audience typically here watching the channel, a lot of you are probably dollar cost average in your portfolio. That's why we're taking the numbers that we are. So if you were to invest into Southern Company, you're going to get just under $500 in annual cash flow if you're dollar cost averaging into your portfolio. You're going to get a little over $450 with Verizon, and you're going to get $332 with Coca-Cola. Can you see the difference here, right? If you were to invest into Altria Group and these other heavy hitters, you're going to get more cash flow up front. But for example, a Southern Company, a Verizon, a Coca-Cola, these are growing very significantly slower than the other companies. And this is why the time horizon is so important. Everybody, like if you're in college and you do like a drinking game, everybody should take a shot every time I say like time horizon or portfolio. I've actually gotten a few comments of people saying that. I use those words a ton, but they're so important, when it comes to the time horizon. All right, so when you go down here, you're taking a look at Kimberly-Clark. Kimberly-Clark is fairly similar with Coca-Cola, right? They're kind of perform the same. Pepsi has a lower starting yield, but it's growing a bit faster, right? And so you can see how these different companies, if you were to invest into them, they're going to be yielding different returns. With Pepsi, we're now, at around 300. If we scroll back up here, that's about half of what Altria Group was yielding. So just really, really important. If you go down here, 3M, Procter & Gamble, and Johnson & Johnson and McDonald's, they're all fairly similar, right? Just sub 300. And then you get down here to Air Products and Chemicals and Union Pacific. Then you're going further down the chart. So you're getting fewer dividends if you were to invest into these companies down here. And it's so important that you understand that. And then if we look down here at Waste Management, we got $200, right? And then you got American Tower, $182. And then down here with Visa and Apple, you look at this, $61, $38. This is absolutely insane. If you look at this visually and you think, okay, I get asked all the time, Jake, why don't you invest more into technology? Invest more into technology. It comes back to what I said earlier with my goal is to never sell my shares, right? That's my goal, okay? And so if I never want to sell my shares, I'm going to need millions upon millions of dollars of Visa and Apple to reap the benefit of the dividend, to live off of the dividend. Now, that's why it's so important for me to structure my portfolio in a way so that, in 7 to 8 years that I can live off of the portfolio. I can't live off of $61, right? But you come up here to a Kimberly-Clark, a Verizon, a Southern Company, $500, right? That's where we're talking, right? And the goal for my wife and I is we want to build and construct a $2 million portfolio, right? And so with our portfolio, we're not going to just have $10,000 in it. We're looking to build a $2 million portfolio. So the representation here with $10,000, $600 might not sound like a lot, but if you compound that up all the way up to 2 million, now we're talking in the tens of thousands, right? But if you compare that down here to Apple and Visa, no, I mean, it's not going to work, right? And so that's why I say not every 20-year-old should invest into Visa and Apple. You shouldn't. It really comes down to, when do you want to live off the dividends, right? That's the key thing. When do you want to live off the dividends? And do you want to never sell your shares? Those are the questions that you need to answer for yourself. And really, it's so unique and so individual to every person. I don't think there's a one-size-fits-all approach when it comes to this. So if we look at the whole chart here, you can see clearly that, if you're looking to retire earlier, you want to invest heavier in the companies up towards the top, because then you're leveraging the dividend, you're getting more bang for your buck, right? That's the big thing. So it's so important that everyone out there that is looking to build a new portfolio or revamp their portfolio, that you understand this. When building out your portfolio, the best thing that I can recommend is work backwards. Work backwards and first answer the question, okay, do I never want to sell my shares? If you never want to sell your shares, then it's clear, okay, you want to focus on the companies that are maybe yielding a little bit higher, have a higher starting yield. If your plan is to say, okay, I want to invest into EV, I want to invest into Tesla, I want to invest into S&P 500 or technology, and then sell out of my shares in the future and then buy into, higher yielding companies, that's completely fine. But that's the first thing that you have to understand and ask yourself, okay, what is my ideal future state in 10, 20, 30 years? And then construct your portfolio in the way that it's going to meet your goal. If you never want to sell your shares and you have 20 years or 30 years, then that's where we're looking at, okay, we want to look at the Air Products and Chemicals, the McDonald's, the Johnson & Johnson's of the world. And that's, once again, the video last week that I made is really going to make that much clearer when it comes to calculating the math behind which investments you should put into your portfolio based off of your time horizon. Now, I want to shift gears for just a second, and I want to talk a little bit about planning for the future. When we talk about 10, 20, 30 years into the future, there are so many different things that could happen, that can go on outside of your control. I mean, hell, EVs could take over the world. Bitcoin could be the new norm, and who knows, right? Like, there's so many different things that could happen. And I think what's important for me and for my wife when we're planning our future is to focus on what we can control. I can't control what's happening in the market. I can't control everything that is going on, but what I can control are those three things that I always talk about: staying out of consumer debt, cutting my expenses, and trying to make more money. And I think one of the most important things that the average person can do is really focus on not trying to time the market. If you're trying to time the market, it's so incredibly emotional and challenging. I've been investing for almost 15 years now, and it's really been quite the roller coaster. So what I've decided is to focus on dollar cost averaging. And that's why I absolutely love M1 Finance, is because it's not geared towards your short-term swing trader. M1 Finance is really tailored for dividend investors with a mid or a long-term investing time horizon. Now, I know that with other brokerages you can I know with Robinhood, you can dollar cost average with their fractional shares. You can invest into companies on a weekly basis. But what I like about M1 Finance is I'm focused on the overall portfolio. So the overall portfolio, I have 50 holdings in my portfolio. And I don't want to just invest into one company, because all the companies are growing differently, right? So with other brokerages, you can dollar cost average into individual holdings and set up individual holding, transfers. With M1 Finance, all you have to do is set up your transfer. You set up your rules and say, okay, I want to transfer on a weekly basis a certain amount of money. For example, what I'm doing right now is I'm transferring over $1,000 a week into my M1 cash flow portfolio. And then what happens is when I'm transferring over to the portfolio, M1 Finance is going to then go in and automatically purchase the holdings that are underweight in my portfolio, right? We talked a little bit earlier about underweight and overweight, what that means. So what that means is is M1 Finance, through their dynamic rebalancing, is automatically rebalancing my portfolio without me having to trigger a taxable event. A taxable event meaning I don't have to sell off of anything to purchase anything else, right? That's what I mean by a taxable event. So if you're a long-term investor and you want a dollar cost average and set your portfolio on autopilot, this is a great way to do it. Now, I've done this with Vanguard and with Robinhood. The thing that I like about it better here with M1 is I'm able to do it with my entire portfolio and not just individual companies. And the thing that's great is when you get a dividend, M1 Finance is going to reinvest the dividends into your overall portfolio based off of the weighting, if something is underweight or overweight, based off of your target allocation. All right, the target allocation you set here. For example, if I wanted to change the target allocation, I could change this to say, okay, I want to bump this up to 15. I'm going to lower this, right? I hit save, and then the next time I invest into my portfolio, M1 Finance is going to automatically rebalance my portfolio based off of the target weighting. I think with the pandemic here in 2020, now in 2021, our investing habits have greatly changed. I work with different individuals that are typically in their 20s, and I ask them periodically, hey, are you investing into the stock market? And typically the response that I get is, yes, I'm investing into cannabis. Yes, I'm investing into Bitcoin and Tesla. Those are the hip things. That's what the majority of people in their 20s are investing in. And there's no hate on that at all. I just think it's a very different way to investing. Investing really has changed. And I think with innovation and technology, in many cases for the better, right? With M1 Finance, I wish I had M1 Finance 15 years ago. I think the way that the market, the way that young investors are investing into the stock market, I wouldn't call it investing. I would call it short-term swing trading. And whether or not we want to say that's a good thing or a bad thing, I don't know. But I think it's important to understand that the way that we view investing has dramatically changed. And I was listening to an interview from Mark Cuban on CNBC around this, and I thought it was so interesting. I want to share a brief clip of that.
What rights do you have as a shareholder when you own a share of a company that doesn't pay a dividend? If that company has a lot of discounted cash flow, are they actually, and they don't pay dividends, and they're not growing, and they're not investing, maybe they buy some shares of stock back, maybe they issue more options for their executives, but what do you truly own? There was a point in time, back in the day when you owned a share of stock, you felt like you were an owner of the company. Now they have multiple classes of stock. You don't really own anything. What you own is the right to sell it to somebody else. It is effectively a digital representation of a share of stock that gives you the right to sell it or to buy it from somebody else.
I think the important thing there is you have to understand if you're investing for the long term, you have to really understand that you're a shareholder. You own part of the business. I think the things that Mark is saying there are so interesting and so profound that every new investor has to understand. If you're new to the stock market and you're seeing all this noise, all these, you see a company's going up 30% overnight and then dropping another 30% the next day, that's not investing. That is trading. And what I talk about on my channel is investing into businesses that are generating value, creating cash flow, and rewarding me as a shareholder in a growing dividend so that I can live passively off of the dividend income from these businesses that I'm investing in, so that it creates freedom and flexibility in my life. Dividend investing is really a true form of passive income. I love investing into businesses that I feel I understand their business model, I understand what they do, their growth potential, and I sleep well at night. I don't go to bed at night worrying if I'm going to lose everything or if I'm going to hit big and get rich overnight. Dividend investing is a long-term investing strategy, and I absolutely love it. Thank you so much, everybody, for watching the video. If you love dividend investing, you love the video, give me a thumbs up, and I'll catch everybody in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.